Meta Platforms is the parent company behind Facebook, WhatsApp, Instagram, and Messenger, and the company is one of the largest in the world. They reported earnings after the market closed today, and their top line revenue grew above near 25%. That is an incredible growth rate for a company this size, and yet shares were trading down by over 10% after hours. What is going on here? Let's take the next couple of minutes to try and figure this out. My name is Brian Stoffel. At the time of this recording, I do own shares of Meta. Give a shout out to Fiscal AI for sponsoring today's video. All right, so this was Meta's second quarter of the year. When it opens tomorrow, it'll roughly be a $1.3 trillion company. On the top line, revenue grew 28% to $60.8 billion for the quarter. That beat analyst estimates and came in well ahead of the midpoint of management's guidance. The trouble is when we look on the bottom line. $6.18 per share was 13% less than last year and well behind analyst estimates. And you'll see this start to show up in a lot of different areas. Now, there was a one-time legal charge. Perhaps you heard about the case against Facebook and its addictiveness, but even if we account for that, it still didn't look super pretty when we look at margins and profitability. Gross margins were down slightly, but are still top-level gross margins. Operating margins fell much more. Now, if we take that $2.4 billion legal charge out, the operating margins would have been 34.8%, but still meaningfully below where they were last year. Net margins also meaningfully below where they were last year. Free cash flow, oh boy. Perhaps you've heard Meta, as well as Google, Microsoft, and Amazon, are spending hand over fist to build data centers throughout the country. That shows up on the income statement over time, shows up in the free cash flow immediately because capital expenditures get subtracted out. That's why the company went from $9 billion in free cash flow to just 1.7. As I said, it shows up over time in the income statement. And in fact, the income would have actually been up had it not been for that legal charge. But also look at this. If you follow Meta at all, you know that it has had one of the most pristine balance sheets of any company ever in existence until very recently. And now its net cash position is almost break even. It's expensive to build these data centers. Let's go down the income statement to see what's going on. So, as I said, 28% growth in revenue, but 33% growth in the cost of that revenue. Because let's face it, the company has done a great job of using AI to increase engagement, but that also has requisite costs for compute, and that shows up. The big thing is this. I mean, just look at this. The operating expenses grew 65%. Now, that does include that legal settlement, but even so, look at research and development. They spent $12.9 billion last year's second quarter, 21.7 this year. No legal settlements in there. And this is the depreciation of everything that they've already built out. It is starting to show up, and that's why income from operations shrunk 8%. It would have actually grown without that legal settlement, but nowhere near as fast as revenue, so it still would have been coded red. Net income shrunk 14%. Shares outstanding were about even. Because look, the company needs cash right now. It can't spend its cash buying back shares. They are spending money that they don't have. In fact, their free cash flow is trending towards about break even. But that's not the whole story. There's a lot going on here. And for that, we're going to head to Fiscal AI. This is a tool that I use every day. If you're an individual investor, you need a tool like this to help you out. Simply click the second link in the show notes below, and you'll get 15% off an annual membership to Fiscal AI. So what I've done is I've gone over and I pulled up a couple of things. The first one is family daily active people. Now, what the heck does this mean? Family means you use one of the apps in Meta's family, which is Facebook, Facebook Messenger, Instagram, or WhatsApp, and you use it daily. We've got 8 billion people in the world. 3.6 billion, almost half, use a Meta product every single day. And what's incredible, because it's working off of such an enormous base, is that it's still growing. Some people might scoff at this, but I think if you're growing daily active people 3% and it's off of a base of last year, 3.5 billion people, that's pretty good. They got 120 million more people to use this every day. That's more than the population of most countries in the world. So hats off to them for that. Of course, that's not the only thing that we're going to look at. The other thing is, we have to remember that Facebook is still an advertising company, and the advertising company is fantastic right now. It is firing on all cylinders. The number of impressions of ads was up 14% last year. Now, normally, when the number of ad impressions is up, the cost per ad is down because they're lower quality ads. But again, the company is using its AI compute that it has, and it is sicking it on its ad business, and it is increasing engagement. Here's the proof. The price per ad impression grew 12%. So again, this over here, as you see in 2023, and I can actually pull this back to show you even more so, usually when ad impressions goes up, cost per ad goes down. That's the normal historical pattern that Facebook has had over its life as a public company. You can see it play out. It's only since the advent of AI right here that we see both of them going up. So this is a machine that is working very, very, very well right now. The underlying business that Meta has is strong. The problem that the market has is not the underlying business. And in fact, we can see this in a lot of areas. This is the average revenue per user. Okay, so for instance, my family, we've got 4 people in it. Only 2 of us use social media, but if all of us did, the average revenue per user worldwide is 15. The average revenue per user in North America is much higher, but they get, amongst a family of 4, they're making $60 just amongst that family of 4, and they're not really charging them anything. The average revenue per user, for some reason this didn't update, came in at $16.86, the highest it's come in before. And that is 23% higher than the year ago quarter. So everything is looking really good on the underlying business. It's the spending on compute that's got people a little bit worried. It is worth noting, though, as well, the midpoint of management's guidance was for 22% growth of revenue in the current quarter, the third quarter of 2026. Analysts were expecting more than that, 23% growth. So that is an issue. It is something that we do need to keep our eye on. What should investors watch moving forward? I am an investor myself. The number one thing is guidance for capital expenditures. I'll get to that in just 1 minute. The second is the family daily active users. We downplay that because we take it for granted, the fact that they have been growing this off of such a huge base. As long as I can stay positive, even in the low single digits, that's great. The third is the chart I just showed you. The number of impressions and the price per impression continuing to go up. And fourth is new revenue lines. Now, I think the moat around this company is definitely widening. I think the thesis is on track, although we do need to talk about the spending. But let's just talk a little bit about what I heard on the conference call. Because while the ad business is doing so well, what everybody is focused on is the amount of money that the company is spending on data centers, AI, infrastructure, all of those things. Now, it's worth noting that management did say during the call that they were not raising the top end of their guidance for capital expenditures for the year. They were keeping that where it was. They did raise the floor. So overall, the midpoint of capital expenditure guidance went up, but not by that much, and not by as much as we've been hearing from the other hyperscalers. It went from 135 billion to 137.5 billion. And on the call, really, what the whole call was just questions about what are you going to do with all of this build out of AI capacity that you have. And Mark Zuckerberg said that right now the big picture is there's nowhere near enough compute to meet demand. That's a quote. And he said that, look, they're going to build out their compute. But what he said investors are really kind of frustrated with, but I actually think is really worth pondering. He said, look, we're not going to commit to how we're going to use that compute. We believe that we have uses for this compute that are going to help our company. And so we're not going to lease it out to all the other people, even though they're offering huge profits for it. we could take those profits right now, but we'd be cutting ourselves off at the knees because we believe that we can build out tools that will be even more profitable in the future. The question is whether or not we trust Mark Zuckerberg to see this plan through, and if he's right about these new lines being more profitable than what they currently have, and more profitable over the long term than what they're being offered for their compute right now. So that's pretty much how the whole conversation went. He said, look, we want to reserve a certain amount of our compute for our own purposes, and we don't really have, it's not a priority to become a cloud computing company. He didn't cut it off. He didn't say they won't do it. He just said it's not a priority. Now, mixed in among all of this is just a matter of what about the company's valuation? Well, we'll get to that in just a minute. But first, if you benefit from educational content like this, you'd be a perfect candidate to join my program, Stock Investing Mentor. There's 3 pillars to Stock Investing Mentor. First, you get live real-time access to my portfolio. Second, you get access to the antifragile universe. That's every stock that I own, every stock that I follow, with its antifragile score, with its valuation rating, and even with the 3 KPIs that I think are most important to follow when, say, a company reports earnings. And finally, you get live training, 1 hour of live training every week that's recorded, and 24/7 access to a private online investing community. Oh, and by the way, you also get access to Stock Simplifier Pro, a tool that I'm going to show you in just a minute, and you get it 100% for free. If this interests you, click the top link in the show notes below, and you'll get 10% off an annual membership to Stock Investing Mentor. So I told you we would talk about the valuation for Meta. So I'm in Stock Investing Mentor. Obviously, Stock Investing Mentor believes not only that Meta has a wide moat, but that it's widening. But what I'm going to do is I'm going to go to this valuation tab right here, and I'm going to go to the reverse discounted cash flow analysis. Now, here's what I want to do. I believe that Meta is a wide moat business and that they have pricing power. So I'm going to pull this terminal growth rate up to 3%. Now, the next thing I need to do is set the discount rate. I'm going to keep it at 10% because that means it is a market. What needs to happen? What is assumed if this is a market matching investment over the next 10 years? And the market typically returns 10% per year. Now, the next thing is we've got to talk about margins. So what is an optimized free cash flow margin for Meta? Well, right now its free cash flow margins are down to about 18%. But if we look at the company's history, it's been as high as 42 or 43%. Now, I think that these investments in AI are going to pull those free cash flow margins down. That's okay, but I don't think that they're going to be 18% either. I think they'll be higher. I believe that their free cash flow margins will settle somewhere above 30%, below 35%. So I'm going to put a 33% optimized free cash flow margin in right now. So let's give Meta that optimized 33% free cash flow margin, and then let's ask ourselves, how fast do we see the company growing over the next 3 years? Well, analysts see the company finishing this year out with 26% revenue growth, followed by 20% and then 18% revenue growth. Well, those are just estimates. How have analysts done in estimating this before? They have chronically underestimated. That you see these lines moving up. These are estimates for this year's revenue. It started out, they said in 2026, they'll have $210 billion in revenue. Now they're singing a different tune to about $250 billion. So if I go back and I look at this and I just try and eyeball, what is a reasonable growth rate over these 3 years? I think that they could grow about 21, 22% per year over the next 3 years. Now, here's why this matters. If I'm doing split growth here, so I'm saying over the next 3 years, I believe that they'll grow 22%. So let's look at this for just a second, because this is actually a little crazy. If Meta can grow 22% over the next 3 years, and if Meta can get a 33% free cash flow margin, now that's the big question. They're leaving all this money, they're leaving it on the table. They're not taking it by not becoming a full-on cloud computing company because they believe that they can reinvest it. And so far, we've seen that reinvestment work. So if they can get 33% free cash flow margins, and if they can grow 22% per year over the next 3 years, then revenue can not grow at all over years 4 through 7, and it should still return 10% per year. So I think this is a very, very undervalued company. I understand the risk, but I think it's very, very undervalued. Let me know what you think about this in the comment section below. Everything boils down to whether or not capital is being allocated correctly in terms of these AI data centers and how that's going to play out. Let me know what you think in the comment section. Don't forget to hit subscribe. And until next time, Brian, out.